Well, I think what you can say, both from some of the consensus discussion and also from the data, is that there are parts of the economy that are slowing down. Housing is certainly, I guess, running out of buyers is the way I would put it. We still have an inventory problem, but over time, this is going to fix itself. People have to move sometimes. There are other things that occur in the family life cycle that just force people to move. So you're starting to see a little of that, but we're a long, long way from any kind of housing boom like we saw back in 2021, 22. We barely did $1 trillion worth of mortgages last year compared to 5 during 2021. So the industry is kind of very quiet now. And the rest of the economy, depending on what you look at, I think it's not a bad picture. We continue to see a lot of volatility in the week-to-week and month-to-month data that the economists look at. In terms of credit, my industry, as we go into second quarter earnings, it's not horrible. It's still mostly a commercial credit story, and the consumer is the big question mark. That's really what people don't know. Now, we did do a piece on the Fed stress tests overnight that we put up on the blog. And what I would tell you is if you look at the numbers that the Fed assigned to certain banks, it makes you wonder how worried they really are about a recession. It says to me they're quite worried. Well, I think like most analysts that really focus on the micro data from financial institutions and public companies, we worry about the volatility in a lot of these data sets. We worry about rate of change showing up in, a future quarter this year, for example, in consumer defaults. That takes everybody by surprise. But is it really a surprise? We've had defaults in credit generally suppressed since the 2008 crisis. That's what low interest rates do. They force asset prices up, home prices, for example. So it's hard to lose money if somebody actually, defaults on their mortgage and you have to foreclose. That almost never happens. Mostly consumers who are in trouble, who've had a couple modifications that have failed, they'll sell the house and keep the excess. And that's what they should do. Go find a rental and put the cash in their pocket. So, the home price activity we've had in the last few years is an opportunity to help people who maybe ought to get out of the housing market now. But at the same time, it's not horrific, not at all. Well, when you have commercial defaults, you mostly don't see them. They happen in a conference room somewhere. And only if it's big enough that it becomes a publicly reported event do people focus on it in the news. It hits the headlines in Bloomberg or the Wall Street Journal, right? With consumer, it's in your face. And government is focused on consumer. So if you see an uptick in defaults on credit cards, auto loans, what have you, it immediately hits the news because that's, it's front row. That's what all media organizations are focused on, consumer, because that's where the people are and that's where the political focus is as well. That's how you get attention. Politicians don't want to talk about helping commercial landlords with, shopping malls that are going into foreclosure. But they should, because a lot of these businesses were damaged during COVID. They had apartment buildings where people were given forbearance on their rent and they never made it up. So you're seeing a lot of these small and mid-sized developers forced to default. In fact, Starwood just had another default last week out in California. So it's all over the place. And again, it's a commercial story, so people don't hear about it. It doesn't affect the narrative, but consumer does. You see consumer defaults on credit cards significantly higher in the second quarter, which is possible. Then I think you'd see a change in mood. Well, it depends where you are. Commercials, like all real estate, is a local story. So Chicago, for example, where you have had multiple defaults by large office buildings inside the loop in the whole downtown area. You've also had a number of apartment buildings along the lake trade. And these were heretofore very valuable, premium kind of properties, but some of them have traded at half of the last assessment. So when that happens, the developer gets wiped out, the bank or the non-bank lender, the REIT ends up owning the property, and they have to decide what to do with it. Sometimes they sit on it for a while and fix it up and then try and, sell it, or they try and get more tenants. But it's a struggle because essentially this is a business that may have perhaps half of the building occupied. So it's hard to make the numbers work if much of the asset's not utilized and you still have to maintain it. So that's really the challenge with commercial, and it depends where it is. You could have properties that are great, especially new properties that demand premium prices today. But having said that, the older stuff that's down the road from a new development is going to go down in value. Well, the regulators dropped what we called troubled debt restructurings a couple of years ago. And in the place now, we have a different kind of disclosure of delinquency. And what this means is, let's say I have a building that was owned by a New York Community Bank, for example, in New York City. And the guys, have been having problems keeping up with their debt payments. So we put them on interest only. They're not paying principal. And we've extended the loan. It originally was supposed to come due last year. We just extended the loan. Now, that loan is not worth what it was. You can't sell that loan without taking a loss. And the tenants, obviously, you want to try and keep them in the building, but it just makes it so difficult when analysts and credit people don't have data because the regulators have said, well, if you modify the loan, you can pretend it's paying as contract. When you and I both know that if they're paying less every month, or if they're not going to have to redeem principal this year, if we're going to kind of sidestep that issue, then you really don't know what the bank's asset quality is, looking at their numbers. And I think that's a big issue because, in the age of progressive love, especially since COVID, we decided that it was okay for people not to pay their bills, not to pay their loans, not to pay their rent. And we have kind of forgotten what that implies for the owner of the building, because over time that can really damage them badly. And sometimes they'll just walk away. They'll hand the city the keys. Now, a lot of cities will try and prevent a lender from walking away. They'll force them to take care of the building because it's still in their name. But if you read about some of the rent-stabilized buildings, read The Real Deal. It's one of my favorite reads because those guys are in the weeds. They are reporting on this silent crisis we have in commercial real estate. And, being a young reporter at that publication must be great fun because they can't keep up with it. There's so much stuff for them to focus on. They're probably looking at 1 of 10 defaults. I think the Fed is trying to wait as long as they can to see if they can buy back as much credibility as they can on inflation because they know that they're going to have to lower rates. If you look at the stress test assumptions for Wells Fargo and Bank of America, which are arguably the two weakest of the big banks in terms of income that they can use to clean up a mess, the Fed's worried, I think, about a recession next year, clearly. So given that, they're going to try and wait, hopefully beyond the election. I hope the Fed doesn't act before the election because that would be a political disaster for the FOMC. And then, maybe a rate cut at the end of the year just symbolically. But how much lower does it really need to go? That's the real issue. Are we going to roll back housing prices? No, we have a supply constraint. I've been re-editing my first book. As you know, it's going to be reissued next year, inflated. And if you go back through what Paul Volcker really did to this economy, he caused housing prices to fall by about 20%. Do you think this cast of characters we have today would tolerate that? No, not at all. So we live in different times. Since Richard Nixon, really, the idea of borrowing money to pay for today's expenses has been fashionable. And we're still doing it, Yeah. It's really remarkable. So the Fed they're in a tough spot because as long as the Congress is going to keep funding 20-25% of federal spending in the debt markets, we're running hot. I was rereading Arthur Burns' comments early on when he was telling Congress, he said, if you increase the deficit, I will increase interest rates. Can you imagine Jay Powell saying that today? So we've really given up a lot of ground in terms of the fight on inflation. And I think eventually we're just going to give it up. And, 2% will become zero. And then we'll probably have to have a higher target, to take care of. Remember, this was a political construct. In the 70s, Congress, the Democrats in Congress wanted to guarantee everyone a job. So the compromise was Humphrey Hawkins. And they said the Fed will ensure full employment, quote unquote, and price stability. And also there was a third aspect of it in terms of stable long-term interest rates. But you can't have stability in terms of prices if you're going to run big deficits. You can't. In a fiat system, if you put leverage on the already leveraged currency, then you're going to have problems. And I think we've proven that in spades. The only reason we get away with this, Julie, is that the rest of the world uses our money as a means of exchange. They like to borrow in dollars. The Chinese love to be short dollars because they assume eventually they're going to go down. And that's why they buy all that gold. The Chinese have a long-term bet that says the dollar will go down and we will own gold. Same with the Russians, by the way. I think it would do enormous damage to the credibility of the Federal Reserve Board. I think members of Congress might even call for Powell to resign. The Republicans certainly would. It's just not a good idea. You don't want to take over favorites in a presidential election, whether you're going to stay on or not. I think it's pretty clear Powell will retire sooner rather than later. But do you really want to put the Fed into the middle of the mix? See, we've created this media circus around the Fed. And so all of the economists who make a living predicting what the Fed is going to do, and media too, have to have a wide variety of guesses out there where they can speculate about what's going to happen. That's how I view people who, even the Goldman Sachs economist, for Christ's sake, was talking about a, midsummer cut when David Solomon was out telling people that they weren't going to cut till next year. Well, David's right, obviously. I think that there is an impact on the commercial side. Over time, it does have a very depressing impact on the economy when you're destroying billions and billions of dollars worth of value, tens of billions. And you're also impacting the tax base in a lot of large cities around the country, and not just the legacy cities, not just the blue states, okay? We're talking about Dallas. We're talking about Miami. There's a problem when you build a lot of new, the old stuff goes begging. And that's always the case, especially in Florida. New gets old real fast because of the environment and other factors. So if you have a brand new mall or a brand new building that's built to code and it's going to resist all of the things that affect properties down in Florida, the older buildings are going to go at a discount. I think that will, over time, trickle into the consumer side. You'll see employment hurt in some of these spaces. And that, to me, I travel a lot around the country. I always try and keep a finger on how the local people feel. Dallas has certainly calmed down over the last year. It went through a period of growth in that whole area out towards the airport, largely driven by the housing industry, by the way. They all moved out of California and went to Texas because they cut their cost of living in half. That's how expensive some of these blue states are for business now. So, there's a lot of factors involved. All I can say is that consumers will eventually get in the game, Julia. You can see it in the delinquency numbers for the lowest income cohorts in the United States. Those are the people who are getting beaten up right now. You can see it. But the problem is that home prices are so strong, you don't see it in defaults. So it's kind of this silent crisis where people get modified and eventually they're forced to sell. Here's a number that'll, I think, really impress you. 80% of the payoffs today are for people who are selling their homes outright. A year and a half ago, 80% were refinancing their homes. Okay? That's a big difference.
It is.
And when people are forced to sell and take that money off the table and go find another place to live, that tells you how much stress the average man is under right now.